Hello traders, welcome back to the new video in our exciting series. I am Sanjay from Tribe International and I am thrilled to continue this journey with you. Tribe Hub, where financial empowerment begins. This session is powered by Tribe Hub, a place for all financial education, an initiative by Tribe to empower traders with knowledge, tools, and community support to excel in the financial markets. Today, we will deep dive into one of the most fascinating yet lesser known aspect of Forex trading, non-deliverable forwards or NDFs. Video Part 1. We will understand the concepts of NDFs. In this video, we will unravel the mystery of NDFs, understanding why they are essential for emerging markets, and we will learn how to use them effectively. Whether you are a trader looking to diversify your portfolio or a business managing foreign exchange risks, this video has something for you. Understanding non-deliverable forwards. Have you ever wondered how multinational companies, hedge funds, or traders navigate the complexities of restricted currency markets like China or India? These markets are subject to strict capital control, making direct trading of their currencies almost impossible. That's where NFDs come into play, a powerful tool designed to overcome these challenges. What are NFDs? A non-deliverable forward is a cash settled forward contract. NFDs are financial derivatives used to trade currencies in market where direct currency exchange is restricted due to capital controls. It can be Brazilian real, Chinese yuan. Alright, so these countries have strict policies where you cannot trade or take delivery of the currency. Unlike traditional forwards that involves physical delivery of the currency, NDF are settled in cash, usually in a convertible currency like the US dollar or euro. Step by step, we will simplify this concept in our next slides. Before going deep into the concepts of NDF, let us understand why NDFs are important in restricted markets and how they can help different kinds of players in the market to trade those restricted markets. First is overcoming currency restrictions. Many emerging markets like China, India, Brazilian real, and other have capital controls that prevent the free flow of their currencies across borders. So, NDF allows foreign participants to trade and hedge exposure to these currencies without requiring physical delivery by bypassing restrictions legally. So, you can trade freely without hurting any of the legal formalities of that particular country. NDFs can be used to hedge against currency risk. NDF allows companies to lock in exchange rates, ensuring stability in costs or revenues linked to foreign currencies. Businesses operating in restricted markets face significant risk from currency fluctuation, which can impact their profit. For example, a Chinese exporter selling goods to US can hedge against CNY depreciation using an NDF to lock in USD CNY rate for future payments. Because when we are doing foreign transactions, the payments are not exchanged immediately. They can enter into a forward agreement or they can enter into an NDF agreement. So that is why they need to lock that particular amount from the risk of currency fluctuations. So similarly, a multinational importing raw materials from Brazil can protect itself from Brazilian real appreciation. This is why NDFs are a very good tool to hedge the currency risk in the restricted markets. Third one is speculation on currency movement. Hedge funds or any individual person can think of having a good opportunity to speculate on emerging market currencies or any currency which have restricted the delivery. So a trader or a hedge fund can use NDFs to bet on appreciation or depreciation of restricted currency. Example, a hedge fund predicts that Chinese yuan will weaken. They enter an NDF to profit if their prediction is correct. We will see in detail that what will be the process of initiating an NDF agreement. The fourth importance is flexibility without physical delivery. So NDFs are settled in cash in a freely convertible currency like USD, Euro. So there is no need for physical delivery of the restricted currency, reducing the logistic challenges and any cost associated with it. Only the difference between fixed rate and settlement rate is exchanged, avoiding regulatory and legal issues. Earlier also we have discussed that without hurting legal requirements of restricted market, anyone can speculate or hedge their currency risk in a restricted market with the help of NDF. This makes NDFs a compliant and secured alternative for accessing restricted markets. It also supports international trades and investments. Restricted markets often have immense trade and investment opportunities, but currency volatility and restrictions can deter foreign investors. So, NDFs provide an essential tool to facilitate cross-border trade and foreign investment without exposing businesses to uncontrolled forex risk. This encourages many new investors coming into these emerging markets to help them grow. So this is a win-win situation with the help of NDFs. Now let's see how non-deliverable forwards actually work. One US hedge fund have a view that Indian currency will gonna depreciate against US dollar in the next 3 months. So what he can do, he wants to speculate on this view, but emerging market currency like Indian rupees or Chinese yuan, these markets are restricted and the US hedge fund cannot take delivery of the Indian rupee for the next 3 months. So how will he gonna benefit from the opportunity he is analyzing? The answer is he can initiate non-deliverable forwards. So how does actually non-deliverable forwards work? So there are few components of non-deliverable forward contract. First is agreement. The US hedge fund and a second party needs to agree on a contract. In that contract, they need to decide what is the notional amount, means how much money a US hedge fund wants to speculate on. Second is forward rate. Both of the parties have to decide a forward rate. This forward rate will be fixed upon agreement and it will gonna be used for settlements after 3 months of period or whatever settlement date they decide, and then they have to decide the settlement date. As I said, the US fund have a 3 months view, so they will gonna decide a date after 3 months. After the agreement, the second component you need to understand is the spot rate. The spot rate is the actual rate on the settlement date, means after 3 months whatever the current market price is, that will gonna be the spot rate. And in restricted markets or emerging market currencies, the spot rate is published by financial authority or any reliable data source. Then on the actual settlement, they need to calculate the difference between the forward rate and the spot rate and then determine the profit or loss. Then that particular profit or loss difference will gonna be converted into any convertible currency and exchange between the parties. So there is no physical delivery is actually required, making it a cash settled contract only. Now let us understand the whole of this process with the help of a practical example. So the hedge fund have to enter into an NDF agreement with the second party. That second party could be anyone. It could be a financial institution, it could be an individual party, or it could be a party located in any other country other than US or India. So it needs a second party, and the notional amount is $1 million, the amount they are speculating on. Then the forward rate. So in this scenario, the forward rate is 75 rupees per dollar. They have to agree on this price at the start of the contract. Then the settlement period is 3 months. So after 3 months, what happens? In case 1, the rupee depreciates and the spot price becomes 77 rupees per dollar. So the hedge fund had an scenario that rupee should depreciate in next 3 months, and it actually did. Then the difference is 2 rupees per US dollar. Now they need to calculate the profit and loss. So 2 rupees into $1 million are equals to 20 lakhs in rupees. But the US hedge fund cannot take this to 20 lakh rupees of profit in Indian currency. It needs to be converted into US dollar. So to convert it, you can just divide the profit amount in Indian rupees by the spot rate, which will gonna amount to $25,974. So that needs to be paid by the second party to the hedge fund in dollars, because that is the convertible currency. And what happens if the spot rate changes and the rupee appreciates in adverse to hedge fund's view? So in this case, 2 rupees is the loss because the rupee is appreciated to 73 rupees per dollar, and the loss will be same because the change or the difference between both of the cases are same, 2 rupees. So now the loss is 20 lakh rupees in Indian currency. So that should be converted into US dollar, which will gonna be amounting to $27,397, and that needs to be paid by the hedge fund to the second party. So here only the difference is being exchanged between the parties, not of the whole notional amount. No one is taking the actual delivery of the currency. This is how anyone can use this NDF instrument for having a speculative view. There is a second scenario for business and investment purpose. We will gonna see that in later slides. Trading NDFs, non-deliverable forwards, offers opportunities in restricted markets, but it also comes with a lot of unique risk and challenges. Understanding these is crucial for managing positions effectively and avoid significant losses. First is market volatility risk. It is one of the most significant risks associated with trading NDFs. Emerging market currencies, which are typically associated with NDFs, often exhibit extreme fluctuations due to various factors. It can be economic instability because of unpredictable economic conditions such as high inflation, weak GDP growth, or current account deficit. Sudden economic downturn can also cause sharp currency depreciation or appreciation. And political uncertainty like elections, policy changes, geopolitical tensions can create unexpected currency movements. So that is a huge risk for NDF players, and geopolitical events can cause big trouble for NDF players. In example, in 2015, the Chinese central bank devalued the yuan, catching many NDF traders off guard. Those betting on yuan appreciation incurred heavy losses. So, how can you mitigate the market volatility risk? You can use stop loss strategies or monitor macroeconomic and geopolitical events closely to avoid market volatility risk. Second is counterparty risk. It is critical challenge in trading NDF since they are over the counter contracts. They rely on the financial health and credibility of the counterparty to fulfill the agreement. This creates a layer of risk that is unique compared to exchange traded instruments. So basically, counterparty risk is something that a party, it can be bank, broker, or financial institution, they may default on its obligation during the settlement time. And we know that NDFs involve a cash payment based on the difference between the agreed upon forward rate and the actual rate. If the counterparty cannot make this payment, then the other party may face the financial loss. For example, a smaller counterparty failing to honor the settlement amount during financial crisis can result in substantial losses. So how can you mitigate this kind of risk? So you can mitigate with the help of trading with only reputable counterparties that are well regulated and established from a long period of time, which have a goodwill in market. It can be large banks like JP Morgan, HSBC, so they have lower default risk compared to small or local institutions. You can use collateral agreements to ensure that counterparties post asset to back their positions. You can also use central clearing options whenever available. Clearing houses are there to minimize the counterparty risk arising from the individual, or you can monitor the creditworthiness of the counterparty. Third is reference rate risk. It is a significant concern for NDFs as the final settlement of NDF contract depends on an official reference rate determined by the central bank or authorized institution. Any manipulation, delay, or deviation in this rate can lead to financial losses or disputes between counterparties. This reference rate risk can arise due to a lot of different factors. First is that the central bank or the regulatory authority, financial institution, is delay in publishing the particular spot rate, or the reliability of that reference rate is a little bit less because of manipulation by authorities. Regulators in such market may set an official rate that can deviate from the true market rate to achieve economic or political goals. This can distort the settlement outcome for NDF contracts. For example, if a central bank delays publishing the spot rate or adjusts it unexpectedly, it could disadvantage one party in the NDF settlement. So you need to be very cautious around it, and it can trigger disputes or legal issues between counterparties. So what are some points that you need to keep in mind to avoid reference rate risk? You can diversify positions to reduce dependency on single market, and you have to understand the reference rate mechanism. You have to research how the reference rate is determined and its history of accuracy, so that can reduce the discrepancy of reference rate due to any manipulation or anything. Or you can monitor other market indicators, and you can also take reference of other alternative rate sources like Bloomberg, Reuters, if the official rate is unavailable or it is questionable. Alright, so the fourth kind of risk is regulatory and policy risk. It is also a big issue for NDFs, as these contracts are typically tied to currencies in restricted market, where government exert significant control over foreign exchange policies. Sudden changes in regulations or policies can disrupt trading strategies and settlement outcomes. It can be tightening of foreign exchange control or change in monetary policy, or it can be implementation or changes in any kind of taxation or reporting requirements, and sudden policy announcement can also trigger regulatory and policy risk. So you need to keep track of events happening associated with the restricted markets. For example, if India tightens foreign exchange regulation in 2023, impacting NDF settlements and traders' strategies. The simple thing to mitigate these kind of risk is to stay updated on local regulatory developments and use diversified instrument to reduce exposures to specific policies. You can also initiate hedging strategies or put up flexible conditions in the NDF contract. Fifth type of risk is liquidity and pricing challenges. Especially in restricted market or emerging markets, these challenges can lead to higher transaction cost, reduced flexibility, and increased difficulty in managing positions effectively. This can happen due to limited market participations, less known or highly restricted currencies may have very low liquidity or very low interested players in it, that can trigger wider bid and spread, and it can also cause difficulty in exiting large positions without incurring losses. For example, in a thinly traded NDF market for the Brazilian real, a trader trying to close a large position may face unfavorable pricing. So the bid and ask spreads are very higher, so his profits may decline due to these spreads, or he even may face a wider loss. To reduce this kind of risk, trade in more liquid contract when possible, or you can avoid taking overly large position in these exotic currencies. So these are some kind of risk that are associated with NDF trading. I hope you have a general idea now. Video part 2. We will understand some strategies to trade NDFs. Non-deliverable forwards offer traders a versatile tool for managing currency exposures, speculating on market movements, and navigating restricted foreign exchange markets. So we are going to discuss some strategies so you can trade NFDs effectively. First is hedging currency risk. This is the one of the most common and practical uses of non-deliverable forward contracts. Companies, investors, and institutions use NDFs to protect themselves from the uncertainty of exchange rate fluctuations in restricted markets or volatile markets. Why hedge currency risk? So first is exchange rate volatility. Restricted currencies in emerging markets often experience sharp fluctuations due to geopolitical events and monetary policy changes or market sentiments. That is why you need NDF to hedge that particular currency. Second one is predictability and cash flows. By locking in future exchange rate, businesses and investors can protect their profits or investments from unfavorable currency movements. We will gonna see its example in detail. And last is regulatory restrictions. In many emerging markets, direct access to the onshore currency market is prohibited. NDFs allow offshore participants to hedge their currency risk while adhering to regulations. So, a company or investor with expected cash flow in a restricted currency enters into an NDF agreement to fix an exchange rate for the future settlement date. So, how you can do it? Let's understand it with the help of an simple example. NDFs. So, a US based company imports machinery from India. Alright, and the US company said that they will gonna pay 50 million rupees after 3 months of period. But the company is concerned that the Indian rupee may appreciate, making the machinery more expensive in terms of US dollar. So to mitigate this currency movement risk, or you can say currency exchange rate risk, the US firm entered into a NDF contract. It can be with the same party or with any other broker or any other institution dealing in NDFs. So let's say they have entered into a contract. Alright. And the exchange rate on the date of contract was 84.50 per dollar. Alright. So on the settlement date, if the currency value actually appreciate as company was thinking to, let's say, 82.50. So there is a difference between the contracted price and the current market price, and the difference is 2 rupees per dollar. And if you multiply this 2 rupees difference to 50 million rupees, then the USD requirement will be very much higher for the US company. So to reduce this risk, in this NDF contract, the company has sold Indian rupees at the rate of 84.50. Whatever the spot rate is, their price will not gonna be changed, which was 50 million rupees. Because if due to this change in 2 rupees, if they require to pay 51 million, then they will receive 1 million difference with the other party, because they have initiated an opposite NDF contract with other party. So this is how they can mitigate the risk of exchange rate between the currencies. Alright, so the second strategy is speculation on currency movements. Trader leverages NDF contracts to capitalize on exchange rate fluctuations without needing access to the physical currency. This strategy relies on anticipating future changes in currency's value and taking positions to profit from these movements. So why do people speculate using NDF? Because it makes NDF very easy to access the restricted markets, and leverage also helps the trader take large position in the currency market with minimal upfront capital, and no delivery of physical currency is required, so they can only settle the difference between the spot rate and the contracted rate. And high volatility in these emerging market currencies often create ample opportunities for profit. So how it works? A trader speculate that the exchange rate of restricted currency will either appreciate or depreciate by the contract's maturity date. Then at the settlement date, the trader earns a profit or incurs a loss based on the difference between NDF rate and the actual spot rate of the currency. Here, no goods are exchanged. what example we have seen in the previous slide was a hedging example. There was actually goods was exchanged between two countries and actual payment was receivable, but here there is no goods or no payment is receivable, but instead of hedging they are actually creating a new trade to speculate on the change in exchange rates of the emerging market. Alright, so this is how speculation works. For example, speculation strategies are there. If anyone thinks that INR will gonna depreciate in 3 months or 6 months of period of time, then they can create a NDF agreement according to their need, and they can take directional trades. Whether they want to go long or they want to go short, that will gonna be depending on their view of the currency's future movement. Then second type is event based trades. Speculation can be based on events like elections, interest rate change, or central banks monetary policies or geopolitical developments. So for a short period of time also a trader can initiate an NDF. And macro trend, taking advantage of long-term economic or policy shifts in emerging market. Anyone can speculate for a longer duration of time, let's say 1 year, 2 year or 5 year. Okay, because they are tracking macro trend and they want to take benefit of opportunities offered by the restricted market. Carry trade using NDF. We have seen some example and what carry trade is in the last video of trading yield curves. So carry trade is something that can benefit from interest rate differential between two currencies. Traders borrow in a low yielding currency, for example US dollar, and invest in a high yielding restricted currency using NDFs to lock in future exchange rate. If any emerging market is giving higher return on the debt instruments, then they can initiate a carry trade to gain that particular differential between those two currencies. Fourth one is trading the yield curve with NDFs. So here we are combining yield curve because yield curve can show the direction of the economy's growth. Okay, and if you combine it with NDFs, then it makes it a very advanced strategy that combines insights from bond market with currency trading. The yield curve represents the relationship between the interest rate and bond maturities that can significantly impact the currency prices. Okay, so you can take advantage of those change in currency prices. So why use NFDs for yield curve trade? You can access the restricted markets easily with the help of NDFs, and interest rate differentials can be very huge in those emerging markets. So the opportunity to make profit can be very significant. So you cannot buy or sell on normal markets. You need NDF to trade on these restricted markets. Hedging macro risk. Traders use NDF to hedge currency risk arising from bond investments in emerging markets. And the last one is speculation on central bank policy. Yield curves often shift based on central bank's action, providing opportunities for traders to profit from anticipated moves. Alright, so let's see what are some risks. So the market timing. Misjudging the timing of yield curve shift can result in significant losses, so you need to be aware of that market timings. Second one is volatility. Emerging market currencies are inherently volatile because of its nature. You can see why they are restricted, because they are growing, they are in their developing phases. So that is why the events or the growth rate can change very highly. So this can add risk to yield curve trades. Third is liquidity risk. Emerging market currencies tend to have lower liquidity compared to major currency pairs like USD, JPY, Euro USD. These are major currency pair. A lot of volume is going on in those currency pairs. But in emerging market currencies, the liquidity can be very low. So you need to keep that in mind before initiating an NDF trade. Or regulatory uncertainty. Policy changes in emerging market can be very fluctuating and it can disturb the expected results. So you need to keep track of the regulatory frameworks changing in the emerging markets. Let's see the future of NDF in emerging market. NDFs will gonna be shaped by evolving financial systems, technological advancement and regulatory changes. But NDF are likely to remain a critical tool for managing currency risk and accessing restricted markets. But they will adapt as the emerging market develops, and usability of NDFs will also gonna enhance with time. So what are some factors that are influencing the future of NDFs? First one is increasing demand for emerging market currencies. As global trade shifts toward emerging markets like India, China and Brazil, the demand for their currencies are obviously expected to grow. Alright, and this will gonna increase the requirement of NDFs. NDF will gonna be essential for business investors seeking exposures into these emerging markets. So for example, global corporations into India may use NDF to hedge currency risk as the rupee role in the international trade increases. Second factor is gradual liberalization of the currency markets. So emerging markets are gradually relaxing capital controls, or they are reducing the regulatory framework and allowing more currency to come in so they can boost their growth. And this liberalization may reduce the usability of NDFs in ultra long term, but still the NDFs will gonna adapt itself and they will gonna continue to make a significant impact in the financial markets. The role of technology and fintech. Advances in blockchain, AIs and trading platform will streamline NDF trading effectively, and digital solutions can improve transparency, reduce the counterparty risk that we have discussed in the risks of NDFs. So this was the main factor, and if it is reducing with the help of technology, then it can make the NDFs more accessible to the normal peoples also. Central bank digital currency, CBDCs. So we can see nowadays a lot of new currencies or digital currencies are being provided by the banks also. So this can reshape the NDF market by providing alternative method for cross-border settlement. But these digital currencies become widespread or more commonly used, NDF will remain vital for hedging and speculation in the restricted markets. Fifth is expansion in new market. So whenever a new emerging market wants to expand its manufacturing or infrastructure, they would require investment, and NDFs can be used to get those investment from the abroad economies. Alright, so these emerging economies can benefit from NDF without reducing or liberalizing their capital controls regulation. Alright, these expansion will enhance the relevance of NDFs as a tool for accessing these restricted markets. Enhance risk management and regulations. Regulators are likely to impose stricter frameworks to manage the systematic risk associated with NDFs, and enhanced policies could lead to more secure and transparent trading environment, encouraging more participants. If the risk is less and the return is a little bit secured, then this is very much obvious a lot of people will gonna attract to such instruments. So that is why you need to be aware that where the NDFs are going, how they work, and how you can use to take advantages of those non-deliverable forward contracts. So this is all. for today's video. I hope you have liked the information provided here. Make sure to subscribe to our community channels to stay updated. And thanks for sticking around. If you found this video helpful, there's plenty more to come in our series on Forex and technical analysis. Don't forget, for all your trading needs, visit tribe.com. For more in-depth trading education, head over to tribehub.com. Thanks for watching, happy trading, and I'll see you in the next video.